Welcome to the Passive Income Machine podcast, where we show you how to break free from the grind and achieve real financial freedom in 10 years or less. My name is Ryan D. Lee, and I've helped thousands turn income into cash flow, trade fake money for real assets, and take back control over their time, their wealth, and ultimately their life. Each week, you'll get strategy, tools, and mindset to build your own passive income machine. So my friends, sit back, relax, and enjoy today's episode. All right, my friends, welcome back to the Passive Income Machine podcast. You are on the microphone today with me, Ryan D. Lee. And today I'm excited because I'm going to be talking to you about a core strategy that we use inside of the Passive Income Machine. Now, if you're a brand new listener to this podcast, our objective in our world is to help you, empower you, I guess would be a better way to say, not just help you, but empower you with your money to achieve financial freedom in 10 years or less. Now, we do this through a system, an investment strategy that we call the Passive Income Machine. And one of the central components of this passive income machine is a tool and a strategy that we call the vault. So today we're going to be talking about how to set up your own banking system using the vault financial strategy. The vault is the foundation of the passive income machine because it's the place that all of our capital originates from. Well, we take it from, wherever we're making it, and we store it and grow it in the vault. Then we then multiply our money that's in the vault, and then we use it at some future date to be the source of our tax-free income. So the vault sits at the center of the passive income machine strategy. But for this episode today, I want you to imagine for a moment becoming your own bank, right? To where you could start to duplicate every dollar that you put into a system and turn every dollar into two. What would that do for you if you had the opportunity to take every dollar that you had, every dollar that you're trading your time, your effort, your energy for, and to duplicate it and turn it into two? And then once you've done that, using multiple dollars to build and create more wealth, what if you could eventually convert all of your money in this system into a stream of tax-free income for the rest of your life? Because that's what we're going to be diving into today on this episode of the Passive Income Machine. Now, in order to understand what the vault is and why I talk about it being kind of like a bank, I'm going to start off talking about a banking system. In our economy today, banks are the most powerful. They are the most powerful financial institutions, from the Federal Reserve all the way down to your local bank. They have the ability to literally print money, to create money out of thin air. Now, unfortunately, we're not going to be able to be quite as powerful as a bank, but I am going to invite you to consider you can literally print money of your own, meaning you can take a dollar that you have to trade your time, your effort, and energy for and duplicate it, turn it into two. That's what we're going to be talking about with the vault. But let's consider how banks operate first, right? A bank's business is money. Right? Think about, let's talk about a normal business like maybe Home Depot, okay? If you're going to go to Home Depot has a bunch of, home goods inside of it. But let's take something really simple, right? Let's say you're going to go buy a shovel, right? I mean, I don't know if you need a shovel, but you're going to go buy a shovel because you need it, right? What Home Depot did is they sourced a supplier of shovels. They bought a bunch of shovels at a low price. They then pay that price to the supplier. All of the shovels are shipped to the Home Depot, and then they sell those shovels at a higher price, right? And the difference between what they pay and what they sell it for is called a markup. That's the profit of Home Depot on selling shovels. If they buy shovels for $1 and turn around and sell it to you for 10, their markup is $9 or 900%. Okay, a bank does the exact same thing, but a bank's product isn't shovels. A bank's product is money. So I want you to consider this, okay? A bank has three rules. They need to attract money into their system, number one. Okay, so they need you to put deposits in, the Federal Reserve and, the banking system funnels money in, but you need to put money in, but that's rule number one. Rule number two, they don't just let money sit. They want to leverage every dollar that they have access to. And rule number three, they want to keep their money moving as fast as possible. So they use deposits. So let's say I go put money in, okay? And let's say the bank in today's interest rate world is willing to pay me 2, maybe 3%. I don't know what banks are paying today, but right, a couple percent. So that's the cost of money to a bank, right? They've attracted money. Now, second rule is they're not just going to let my money sit idle. They're going to turn around and lend out every dollar, for the most part, that they're able to collect from the bank or from me, right? And so they'll pay me 3, and they might turn around and lend it out on a loan for 7. Or maybe they turn around and they lend it out on a car loan or a credit card or a mortgage or whatever it might be. But if they're paying me 3 and they're earning 7, that's 133% return on their money. Yeah, it's a 4% markup in interest rate, but it's 133% return on money. And technically, if you really think about it, it's an infinite return for the bank because they're using my money to run their business. So we want to run a system that we can do something very similar with money. I want to have a way that I could put money into a system and I could duplicate the value of my money. I can make my money more productive. I think one of the biggest challenges that most people face, one of the biggest economic headwinds that most people face in their financial system is opportunity cost, right? They park their money in places that inflation is working against them. Taxes are working against them, especially if you park your money in something like an IRA where there's penalties and restrictions for getting your money back. Now, if there might be amazing opportunities, you can't participate or you don't even see them because your money's locked up. So the vault allows you to overcome opportunity cost, and it allows you to do multiple jobs with the very same dollar. Now, the only product that does this is something that I'm calling the Vault for this podcast, but I want you to consider what the Vault is. The Vault is a uniquely designed, overfunded, high cash value whole life insurance policy. Now, you might be thinking to yourself, what the heck is this dude talking about? A vault, life insurance, financial freedom, tax-free wealth, whatever. But here's the thing. If you really think about it, if we break down the tax code, okay, the tax code, tells us where we put our money and what our tax consequences are of putting our money in various different accounts, from a bank to an IRA to a life insurance policy. Now, if I want my money to grow tax-free, if I want my money to be accessible to me at a future date, tax-free, I want to go into this section of the tax code that outlines how I can eliminate taxes from my future. And if we go into that section of the tax code and really look for our opportunities, you'll realize there's not many. There's not many. In fact, there's really only 3. If you want to eliminate taxes from your future, you can use a Roth IRA, you can use municipal bonds, or you can use life insurance. So we're using life insurance for 2 reasons. Number 1, I want to eliminate taxes. And number 2, I want to turn this uniquely designed life insurance policy into a banking type strategy. Now, the policy has to be structured in a very, very specific way. Most people think about buying life insurance for life insurance, right? They go and they get a death benefit. They want to make sure that their family, their business partner, whatever, that someone is taken care of if they pass away and their ability to produce income dies with them. That's how most people buy life insurance. And my friends, you should have as much life insurance as you need. I'm not arguing against that. In fact, I have multiple term policies because I want to make sure that my family is ultimately protected if I ever pass away. But a vault is completely different, okay? I want you to imagine a scenario going into a life insurance agent, okay, and saying, hey, life insurance agent, I want you to build me a policy where I pay you the maximum premium that I can afford to pay. I put in as much money into this thing as I possibly can, but in return for that, I want you to give me the least amount of death benefits. That agent likely is going to be scratching their head saying, what the heck are you talking about? But this is how these vaults actually work. We want to set up a policy that qualifies as life insurance, so we have to get the minimum amount of death benefit based on our age and gender and things like that, but I want to overpay. I want to overfund the policy because all of that extra money that I send into a properly designed whole life insurance policy, all of that overfunding builds up inside of a policy, and I want you to think about it kind of like a separate account. It's called a cash value account. And as long as I have the minimum death benefit to go with all of my cash value, the policy qualifies as life insurance, and bada bing, bada boom, I've eliminated taxes from my future. Okay, now here's why I want my money in life insurance, okay? Number one, all of that cash value is 100% guaranteed. Okay. So just like a bank, when I go put my money into a bank and I think my money's safe and secure, all of the money that I'm putting into a overfunded life insurance policy, all of that extra cash, it's guaranteed by a private contract, by a private company that has met their guarantees for hundreds of years. Now, what do I mean by guarantee? Number one, it's guaranteed that you will have your money growing every single year. These insurance companies give you a guaranteed rate of return. On top of that, we use private insurance companies for these type of policies. And so in addition to the guarantee, you're also earning a dividend. Hey, real quick, before we get back into it, I gotta tell you, if you're getting value here, you'll love the How to Retire in 10 Years Summit. I mean, seriously, everything you're hearing right now, the tactics, strategies, all the insights, they all tie back to this one incredible event. We're laying out the exact blueprint for financial freedom in 2025, and pre-registration is open right now. If you jump in early, you'll get special bonuses that won't last forever. So hit that link in the description or go to retireintenyears.com and secure your spot. Now, let's get back to the show. These companies, again, have paid out a dividend, meaning they're distributing their profitability as a company to their private owners, which are policyholders, okay? These are mutual insurance companies. You don't buy stock in them, but these are some of the most well-known insurance companies in the entire world. They are the backbone of the American economy. I want you to think about companies like Mass Mutual. I want you to think about companies like Penn Mutual, New York Life, One America. These companies are mutually owned by their policyholders, and their policyholders reap the rewards of their profitability through the form of not just a guaranteed return, but an annual dividend. So now I have a place where I can put my money, where my money is growing and compounding, both guaranteed by the insurance company and backed by 100+ year track record. Number two, as long as I've met the IRS guidelines of getting enough death benefits, my policy is guaranteed to grow tax-free. Number three, my money is not correlated with up and down speculation in the market. So every single year, here's the beautiful part, my friends, I'm just getting richer. My money is growing and compounding. I'm raising my foundation on my floor of what money I've kept in my personal economy. And here's the biggest reason I'm doing it, part of the passive income machine system. I now gain access to leverage. I gain access to become kind of like a privatized bank. And here's what I'm talking about. Whatever cash value I have in this policy, okay, let's say I've got 50,000, I might have 100,000, I might have 1,000,000. It doesn't matter, right? However much cash value I've got from all of the overfunding, all of the extra money that I put in, and depending on how long I've had the policy, all of the dividends I've earned, all of the guaranteed returns I've earned, all of the future contributions I've made to my policy, I've just got this sum of cash. Now, that sum of cash is growing and compounding every single year. That's job number one. I now know that my money is going to receive uninterrupted compounding for the rest of my life. That's number one. Now, that's a great thing, but compounding is a function of time. And if all I'm doing is leaving my money in this account and letting it, compound for 50 years, that's cool. But how does that help me be financially free in 10 years or less? Okay, here's how it does it. The insurance company allows me to have a private line of credit against whatever my cash value is. So again, let's go back to a really simple number. Let's say I've got $50,000 of cash value inside of this policy, $50,000. That $50,000, I now have the economic certainty that is growing and compounding every single year, but I can also leverage the value of that money today. I can leverage the value of that money via a private line of credit. Now, here's why this is so powerful. Imagine going back into your, local neighborhood friendly bank and saying, "Hey, bank, I want a loan for $50,000. The banker's not just going to go back into the vault and say, "Okay, cool, here's your $50,000. Bring it back whenever you can," right? No, if you're going to go get a loan from a bank, they're going to kind of do a little bit of, an examination. I was going to use some other words, but I'm going to keep it clean for this podcast. But they're going to make sure that they're getting their money back. They're going to do a credit check on you. They're going to find out what the heck you're using the loan for. They're going to tell you if they approve you, at what rate they approve you, how you have to pay it back, when you have to pay it back, and the consequences of not doing it. The bank is in control. But when you have a private line of credit with the vault, the insurance company standing behind your vault they allow you to access whatever your cash value is from their money. I'm not going to go into the reasons terribly deep on why they do that, but what I'm going to say with that is an insurance company, unlike a bank, has to keep a lot of money liquid, right? And so they give you the ability to leverage that liquidity to accomplish whatever your short term goals are. Now, when you take out a private line of credit from the insurance company, you can only borrow up to whatever cash value you have in your policy. So in this example, we'll say it's $50,000, but you don't have to apply for it. You don't have to fill out paperwork for it. You don't have to ask permission for it. And here's the best part. You don't have to recommit to a repayment schedule. Now, you should repay your vault loan. I'm going to talk a little bit more about that here in just a moment, because in this scenario, you're both the borrower and the banker, right? I want to have the ability to leverage my money today to accomplish my short-term goals, but I want to re-leverage my money over and over and over again. So the benefit is my $50,000 compounds and grows, and I have access to liquidity and control to gain access to the value of my money to accomplish whatever my goals are. So here is how the policy loan would work. The objective would be I'm going to use the policy loan in a few different ways, okay? I'm going to use the policy loan to, first and foremost, as part of the passive income machine, to buy assets. Secondly, I'm going to use the policy loans to cover costs that I would have normally had anyway in my life. I want you to think about this. The average American today, they spend the same type of money year after year after year after year. Holidays come every single year. You buy a car every couple of years. You buy a new house on average to live in every 5 to 7 years. I mean, imagine how much money comes in and out of your personal economy all through the banking system, because you save up and then you spend, and then you save up and then you spend, and then you save up and then you spend. What if you could design a place that all of your money could go, or not all of it, but a decent amount of your money could go, where you could recycle that money over and over again and recapture all of the long-term benefit of not letting money go through your system, but staying in your system so it could grow and compound for the rest of your life. I'm going to spend more time talking about the policy loan provision on the next episode, but for this one, I want to make sure you have a very, very clear understanding of how to set these policies up right. Now, people get excited when they hear infinite banking, or they hear, oh my gosh, I can duplicate the value of my dollar. I can be my own bank. That sounds phenomenal. And then they run right out and they start, buying a life insurance policy. Now, here's the downside of this concept. In order for you to get one of these policies, you literally have to enter a contract with the insurance company. You have to enter a contract. The insurance company is going to give you a contractual guarantee of guaranteed return, guaranteed access to capital, guaranteed tax-free, guaranteed death benefit, all of the guarantees that come with a contract. But you're going to commit that whatever the parameters of your premium structure are, you're going to pay your minimum premium for a period of time. Now, I want to talk about how to set these policies up, because what I see more often than not are policies that were designed to benefit the insurance agent, not necessarily the buyer of the policy. Not all policies, but the vast majority. I want you to consider this. Inside of an insurance contract, how does the life insurance agent make money? Why would he or she want to do the work of, designing a policy for you, getting accredited with the insurance company, getting licensed with the insurance company, setting up the policy for you? All the things that the insurance agent does. Now, they're doing a tremendous amount of work. I'm in the industry. I know there's a lot of work that goes behind setting up insurance policies. Second to that, every policy is designed for the individual. So sometimes people are setting up policies for estate planning, different type of setup. So there's a lot of strategy that goes into life insurance. I totally get that. And we, insurance agents, should be paid for that. So I'm not arguing that, okay? But what I am arguing is when a life insurance agent uses your lack of financial intelligence to benefit them, okay? Now, what I mean by this is in a life insurance contract, an insurance agent gets paid based on the amount of death benefit that they sell you. The bigger the death benefit, the higher the cost is. Not only the bigger the death benefit, the higher the cost is, also the type of death benefit it is, whether it's a term death benefit or a permanent death benefit. Permanent death benefit means the insurance agent's making way more money. A term death benefit usually doesn't pay that much to the insurance agent. So what I mean by all of this is when you're going to set up your vault, when you're going to set up a overfunded high cash value life insurance, your objective is to ensure that we figure out exactly how much money you can and want to put into this policy, how much money you can save per year, not wishing, not hopeful thinking, but how much money you can realistically save per year. Second to that, are you going to front load your policy with any dollars to reposition money to a more effective place? Once we know the total amount of money that you want to contribute to a policy, both up front and ongoing, then this is where the magic happens. The insurance agent should be working with the IRS standards, the insurance company's, design regulations, and determining the best, most efficient cost structure for you. Meaning, they help you buy the least amount of death benefit in the most cost-effective way to maximize the cash value of every dollar you're contributing to your contract. Let me give you just some very broad ratios. So every contract is a little bit different based on the age of the individual, the health of the individual. So these aren't exact specific numbers. But if you're going to do a savings transfer, let's say you have $100,000 in cash, and rather than keeping it in a bank, now you want to put it in an overfunded life insurance policy. You want to build your vault. You should have roughly 85 to 92, 93% of that savings transfer immediately available to you in cash value. Okay, immediately available to you in cash value. If there's less than that, there might be a reason for it, or there might be that your life insurance agent is structuring your contract in a way where you have a little bit more death benefit that puts a little bit more premium in his or her pocket and a little bit less cash value to you. If you're not doing a savings transfer, if you're just saying, hey, I can save $50,000 a year into a vault or into a policy, then roughly, again, numbers vary here, you should have between 70 to maybe 80 on the high end, 70% to 80% in year one of whatever you put into the contract available in cash value. By year two, that number should go up from about 85 to 90%. And by year three, in most cases, not all cases, but in most cases, you should be dollar for dollar, meaning you put in 50, you have 50 available to you in cash value. If there's anything different from that, and there could be reason for it, it just means you're buying probably more death benefit than you actually need. And unless there's a reason to do that, you're unknowingly, in many cases, allowing your insurance agent to gain more commission by setting up your contract. So the most important thing to know is when you're designing a policy, you want your policy to be built in such a way that you know exactly how much you're putting in and you know exactly how much death benefit is required by the IRS. Okay, this is the guideline that we're following. It's called the MEC limits. It's governed by section 770 and 7702 of the tax code. But it tells you, based on the individual, how much life insurance someone has to have based on the cash value that they have to keep it qualified as life insurance. So we want to get right up to that line without crossing it, okay? So that is the biggest thing. I wanted to help you guys understand that. Then the next thing I want you guys to understand is it's important that if you're going to be setting up a policy like this, that you're setting it up as part of a strategy. You're setting it up with someone who's not just selling you insurance, but someone who also is using the same strategy in their own life, who can help you leverage your policy over and over and over again strategically to accomplish your short-term goals. The biggest challenge I see for people who get involved in this strategy is they have a low financial IQ. They don't understand how to be both the borrower and the banker in a system that they control. You, my friends, become the borrower and the banker. And it's very easy as the borrower to, strip all of the cash out of your policy, go leverage it without having any strategic plan to pay it back. In the next episode, I'm going to talk about how and why to pay it back. But in this episode, all I'm going to say is you want to set your policy up with the right team. You want to set your policy up with someone who understands how to strategically and responsibly leverage a policy to build wealth, and how to strategically and responsibly replenish your vault line of credit so you can leverage that policy and leverage that money over and over and over again. Okay, so you want to make sure you set it up with the right team. Last but not least, as part of our system especially, and I'm not going to say that IULs are always wrong, but as part of our system, we want to use the life insurance, the vault, as the guaranteed component of our cash. I want a place to put my money where I don't have to worry about it. I want it guaranteed 100%. The life insurance policy by itself will not make me financially free, but the life insurance policy by itself will protect and multiply every dollar I put into it. When I pair the life insurance policy, the vault, with real estate is my growth vehicle. This is how I'm going to amplify and accelerate the growth of my money. Those two put together, that's how we achieve financial freedom in 10 years or less. Now, why do I bring this up? A lot of people want to think that insurance can be a tool to set them financially free. And so they get promoted and pitched universal life policies as opposed to a whole life insurance policy. There's some pros to universal life for sure. Universal life gives you the marketing pitch that you can participate in market returns with a cap and not have to experience market downturns. Now, I'm not going to go in on this episode and really, debunk that myth, but what I am going to tell you is people who are trying to sell insurance are trying to position universal life policies as a retirement vehicle, as something that will be better than the market. And there's nuances to that. It might be better, it might not. But what I'm going to tell you is life insurance by itself, whether it's whole life, universal life, or any other insurance, was never designed or meant to make you financially free. So you have to have it as part of a system. A universal life policy is sold as an alternative or a better option than the stock market. That's not what it's going to do. There are inherent costs in universal life that aren't in the market. There are caps to universal life of market returns that you can get. And while there might be some safety on the downside, a life insurance policy is never going to get you financially free. So I do not ever recommend universal life as part of what we do, because I want to use life insurance for the economic certainty, for the guarantees, and pair my guarantee with a growth vehicle of real estate. So that is the final word I think I'm going to say on this podcast about the vault. But what I'm going to close this out with is when you pair a properly structured whole life insurance policy, the vault, with turnkey real estate, the world unlocks. In fact, in the next episode, what I'm going to be sharing with you is how you can now turn every dollar that you put into your economic system, the passive income machine, into $5. I want you to sit back and just imagine that for just a moment. What if you could do the work necessary to go out and earn $1, pay taxes, pay your bills, do all the things you have to do, and have $1 net left over to save? I want you to consider how hard you worked for that dollar after your taxes, after your bills have been paid, all of the different things. That dollar that you have represents time that you've traded, attention that you've traded, life force, life energy. That dollar is a sacred dollar. I want to give you the permission to put that money in a place that will honor the sacrifice that you've already made. That's what the vault does. The vault gives you the ability to raise your economic floor, to raise your minimum level of abundance every single year. What would your life look like if for the next 10, 15, 20, 30, 40, 50 years, for the rest of your life, you never lost money? Your account continued to grow every single year. And in addition to that, over the next 10 years, if you're starting fresh from right now, over the next 10 years, you could take every dollar that you put into that system and multiply it into 5. And we would use that multiplication, we would use that leverage to buy enough assets in the form of real estate to achieve quite literally financial freedom in 10 years or less. That's how the vault works. The vault works as part of a system paired up with the right growth asset, which is real estate. And when we put these two things together, you have the ability, you have the opportunity, my friends, to generate 6 figures of tax-free, inflation-adjusted income for life. So that does it for this episode. If you're in the game, congratulations on having your vault. If you're not in the game, listen to the next episode so you understand how the vault actually works. All right, my friends, thanks so much for hanging out today. I really appreciate you tuning in. But before you go, if we talked about something today that made you want to take action, you need to get yourself registered for the How to Retire in 10 Years Summit. It's the financial game changer that you've been looking for, teaching you exactly how to create passive income and financial freedom in 2025. Jump on it early because we've got a special bonus waiting for you. All the details are in the link below, or head on over to retireintenyears.com. So get registered and I'll see you at the summit.